Morning everybody, and welcome to the 7th in our series of bi-weekly webinars, the long and the short of it. We'll start off in our usual place today with a look at what's going on in the markets and what are the topical factors that are affecting our thinking and affecting the thinking of the market as a whole. It'll be a slightly different format today, by the way. When I go through my slides, we'll probably hear a bit more from Clive in that section because there's a lot more crossover today in terms of the subject matter than perhaps we've had in previous webinars. But moving along, let's
I'm ready and waiting for you, Darren. I'm ready and waiting.
Great, looking forward to it, Clive. Well, look, so as you regular viewers will be aware, we start with three or four slides that try and sum up what's going on at the moment, and the first of these is always the mood of the markets. What's the mood of the markets currently? Well, I've used the phrase elated, which means, if you're not sure, it means happy, ecstatic. And why is that? Well, having responded positively to the confirmation that the US Federal Reserve ended its QE markets program, we were given a further shot in the arm as the Bank of Japan effectively doubled the size of its own QE operations to a staggering 80 trillion, yep, that's right, 80 trillion yen, which is the equivalent of 447 billion pounds sterling or thereabouts per annum. So they're going to print and pump that much money into the Japanese economy, and that's in an effort to stave off or export deflation out of the country and import inflation back into the country. And what that meant really is, quite neatly demonstrated by the chart on the right hand side there, which is a relatively medium-term chart of dollar yen, but you can see how we smashed through the big resistance level of 110 and power on to as high as 114.05 since that decision came out very surprisingly at the end of last week. No one was really expecting the Japanese to do anything of that sort or anything of that size at this particular stage. Some might say it's very coincidental that the day after the US ends its QE program, the Bank of Japan massively expands its own efforts at monetary easing. Nonetheless, the markets are taking that very well across the board. Dollar strengthened, equity markets moved higher across the board, and the markets really got what it was holding out for, at least in the short term.
Just a note on that, Darren.
Yeah, fire away, Clive.
Darren, just a note on that. What that saw actually on equity markets was the US markets getting right back up to the levels that they topped out in the middle of September. The S&P futures mid-September got up to 2014. And yesterday printed 2019, so that actually that piece of news on Friday sort of gave it another push higher that saw us making new all-time highs for US equity markets. One of the interesting things about that from a technical point of view, and we can look at some of these charts towards the end of the webinar, is that on this side of the pond, European markets have not been they're nowhere near their September highs, and actually there's a few interesting technical things unfolding with respect to that. So yeah, as I say, we can hopefully have some time to look at those charts towards the end of the webinar when I do a bit on charts. So yeah, I'll let you get on.
Thanks, Clive. Actually, I'll probably just say one thing. Clive draws a very interesting point there, that US markets have reacted, but the European markets haven't. And I wonder, in my own mind, if that's because the Europeans are hopeful of a similar, move from the ECB. Markets really would like the ECB to adopt its own quantitative easing plan, and we may hear more about that I think probably maybe in the very near term when the ECB has its next press conference and interest rate decisions. So
yeah, I think there's a reluctance to do that, isn't there, from the Europeans. I think Draghi's tried his best, Mario Draghi being the central bank governor in Europe, I think he's tried his best to talk a good game without actually doing anything, but I'm sure you've got your views on that, Dad.
Yeah, I think we won't get too far off the beaten track, but I think the big problem with the ECB being able to enact quantitative easing is that they've got too many masters, amongst them the Germans, who are really dead set against it, and so winning them over might be very difficult. But more of that to come, and we'll probably talk about that in greater depth in a future webinar, I'm sure. So if we move on to our soundbites slide, a few pieces of of things I've read and things that resonated with me from the stuff I've been reading in the last week or two. The first is a comment from very well respected HSBC FX strategists, some of whom I think are well known to Clive, someone like David Bloom. But globally, current inflation is only above target in 8 countries of the 34 that we examine. More significantly, our forecast for 2015 suggests that only 3 countries are likely to see or exceed their inflation target. So, across the globe, we've actually talked a lot about inflation in the previous seminars and what it can mean for a currency, but we're going to come on to this the lack of inflation, if you will, and the prospect of deflation. We'll talk about that again in future webinars. So that is a very strange set of circumstances, but just to point out here that it's not confined to 1 or 2 countries. The bulk of the world's developed and developing economies are suffering from a lack of inflation and the prospect of deflation. So now a little comment from the FT to sort of put the move last week in dollar index into perspective. The dollar's autumn rally fizzled out in October, but the end of US quantitative easing and a surprisingly non-dovish Fed statement this week has powered the main dollar index to a new 4-year high today. And that, not surprisingly, we talked about rates potentially going up in the States, and how rates would attract money into, higher interest rates attract money into a currency, and that prospect of that is, it's been writ large in the moving dollar index, and it's pressing on. And in fact, I saw a chart yesterday from Morgan Stanley which suggested that the dollar index had actually broken a trend line, downtrend line that extended all the way back to 1984-1985. So an almost 30-year trend line has been broken by dollar index, and that's possibly, as the piece by Morgan Stanley said, older than the trend line, that is, than some of the people reading the bit of research. And lastly, a comment from a well-read blog called Value Walk, and this is from Goldman Sachs and their view on US earnings. But just put this in really to try and demonstrate how all the things that we talk about in these blogs are tied in and how they affect things in the real world. Goldman says that a $10 drop from the price, or in the price of Brent crude, could make 2015 earnings per share rise by as much as $1, and it's talking about US equities here, but lift 2016 earnings by as much as $4 per share. So a sharp drop from the current levels of around 84 in Brent crude would add significantly to the earnings for US equities. That being said, here's the flip side: a stronger US dollar could put pressure on earnings, and every 10% change in strengthening or weakening of the US dollar adds or subtracts $3 worth of earnings per share to US equities. And when we're talking about US equities here, we're probably talking about the sort of aggregate earnings of the S&P 500 or another broad cap index. So positive pressures, falling oil prices is good for US earnings on the bottom line, but a strong dollar, which we're certainly going to be facing into the balance of 2014 and early into 2015, is potentially negative for US earnings. So you can see there how the push and pull is going to work next year.
Darren, again, looking at the chart, there's been some really interesting chart stuff going on with oil in the last few weeks. Actually, we saw a pretty big drop in the price of the US benchmark oil is called WTI, West Texas Intermediates, traded on sometimes it's often known as NYMEX. People just call it NYMEX. I think you've quoted Brent crude there, which is becoming a bit more of a benchmark because there's a few issues with the WTI contract. But looking at Brent crude today on my charts, I actually said to my clients, we've been given a signal today on Brent crude that suggests it could go to $63, and we're currently at $83. Now, this is one of those times where I think, well, the chart's telling me that, but my brain's telling me that would be a bit crazy. Well, Maybe not, because we have come down since June from $113 to $83, and again that's a chart that I can show people later, you know, a little bit later on once I've got the screen, if you like. But yeah, that's it's an interesting thing that oil prices are suddenly becoming very sort of front and centre, if you like, now that they're falling. One other thing I would say though is Goldman's talking about oil prices. Well, I think you'll find, and I don't want to be done for libel here, but Goldman's are generally not very good at calling oil prices. Historically, they've had some spectacular calls that have been completely wrong. But
Yeah.
maybe,
I think we all remember the talk of a super spike in commodity prices, don't we? And they had a, you know, I can't remember the target, but they certainly had a, you know,
it was $250. It was when oil was. It was back on the last big spike higher in oil prices, which was, you know, obviously back in 2000, you know, when it spiked up to 100 in 2008, spiked up to $145, and the Goldmans did at the time say oil will go to $250, and that was pretty much around the time that it was trading 145. And within a year, not even a year, it was trading 65. And so there's a classic example of one of their spectacularly bad calls, and it does sometimes amaze me that people at these, well-paid people at these big investment banks can continue to be well-paid with calls like that. But there you go. That's just me being a cynical independent, I suppose.
I suppose you know, somebody else might say at least they were prepared to come out with a bold call, although obviously it was wrong. But you know, it's certainly worth remembering and bearing in mind. All goes to make up part of the matrix of decisions, you know, of information that helps us make our decisions.
As the old phrase goes, that's what makes a market, is that different people have different opinions, hey?
Absolutely, Clive, absolutely. Yeah. Right, let's move on and have a look at our next couple of slides. What the money thinks. So in this slide, as you'll be aware, we just try and encapsulate what's going on in the world and what's driving you know, the clever money, the big money, in terms of their investment decisions. Here we've got a slide again we're using data from HSBC. This chart shows how aggressive or otherwise investment banks, central banks have been in using FX to achieve their monetary policy goals over the last 2 years. And the truth is that most of them have become more aggressive or have become more comfortable using FX markets to achieve these goals. What that's generally meant is that you know, central banks have been quite happy to weaken their currency against local rivals. They don't want any strength against, you know, their immediate rivals locally. They want their exports to remain competitive. They want to try and stave off these deflationary influences. They want to they don't basically want to be left out on a limb. They need an outlet for the currency weakness though elsewhere, and that has typically been the dollar. And you can see the red arrows moving up show the central banks in regional areas where central banks have been more aggressive over that time frame, and the blue arrows moving down, which there are considerably less, where the investment banks have been, sorry, the central banks have been more passive. And a good example of somebody being passive or less aggressive here, the UK. Well, we obviously ended our QE program, but look here, look at Europe. Going completely the other way, as we talked about just, you know, a short while ago, the possibility of full-blown QE in the EU, or the preference for it from the markets. So complete divergence, and this again is a topic that we'll come back to time and time again. You know, the cyclical nature of monetary policy at the moment in the world, and this sort of two-tier global economy that's going to emerge, particularly in 2015 as QE unwinds in the UK and the US, but it's expanded in Japan, as we've seen, and probably it's going to be expanded you know, elsewhere around the globe as well, albeit on a smaller scale. So right, well, this week's meat, if you like, on the bone is the trading plan and the psychology of trading, and these two things are very, very important for anyone who intends to try and make money in the markets. It's something that we all come back to time and time again, but it's particularly important for those people that are just starting out or considering starting out in trading. Again, as with all our topics that we cover in these webinars, we'll only ever scratch the surface in the relatively short time we have open to us. But this will give you a flavour, I think, of what's required. It might sound simplistic, some of it, but it's the best plans are built on basic principles, and even the most experienced traders would do well to go back and look at their plan from time to time, and think about what they're doing and whether they're doing it correctly. So the first thing really to consider when we're thinking about taking up trading is the trading day, and Clive has obviously touched on this several times in his end of the seminar, but we'll just run through the way the trading day works again. Market operations are driven by the time zones and banking hours of the world's principal financial centres, and a trading week starts in the Asia Pacific region late on a Sunday evening UK time, and finishes rather with the New York close on a Friday evening UK time. Business moves across the globe as the day advances. As Asia winds down, Europe gets going, and as Europe moves towards its close, the US markets take up the baton on the East Coast, passing on to the West Coast of the States and then back to Asia as the business day progresses. And in each of these centres there are periods of activity and also of inactivity, and busy periods are typically associated with the market's open and close, that is the start and the end of the business day, and the crossover with other markets. For instance, the post-lunch period in London as US markets come online around 1:30 to 2:30 in the afternoon. Quieter or inactive periods in the trading day across the centres include lunch times, and then you get specific quiet periods, perhaps those ahead of a major economic data point. And a typical example of this would be the morning session here in London ahead of the non-farm payrolls announcement in the States, and that's typically the first Friday of the month, and you'll often see that there's limited activity across most markets, most obviously in those markets where there are volume figures, and the volumes would slump well below their usual daily averages. People wait for the news, having had the run-up to the previous 4 days to put their positions on or unwind their positions. Very few people want to actually add to or increase their exposure ahead of the number. Afterwards is a different thing, but ahead of big economic data you'll often see activity fall down. So what does that mean for you? Well, it means that you don't need to watch your screens 24/7, but you should pay attention to what happens at the open and at the close of markets and around important data points and announcements. So in terms of setting yourself up,
one thing I would say, Darren.
Thank you, Clive.
Darren?
Yep.
Sorry, one thing I would say about time of day type of thing is, it's no coincidence that we've timed these webinars to be at sort of 11 o'clock in the morning London time. If we'd have tried to put these out at 7 o'clock or 8 o'clock in the morning, then people are busy looking at the markets. The markets are busy. It would have been very difficult. And the same if you try and do this at 1 o'clock in the afternoon. So we're hoping that people that this is a good time of day for people to listen to us two rambling on, because the markets are fairly quiet at this time.
Yeah, absolutely. I mean, it's a perfect example, Clive. Exactly what we are doing at that time, because it's good for us and it's hopefully good timing for our listeners.
We are now in the lull zone, if you like, between the first couple of hours that are busy in Europe and then the US markets waking up and starting to do their thing.
Absolutely. So in terms of setting yourself up, unless you're going to be trading full-time, and some of you might be considering that, but for many of us we'll have another job, and this will be a sideline. So unless you're going to be trading full-time, you're going to need to be quite realistic about what you can achieve and how much time you can devote to trading. So do give that some sensible consideration, but perhaps you can spare some time in the early part of the day before you go to work, or on your commute or into work, perhaps at lunchtime, or maybe when you get home again in the evening. Now, one of the benefits of trading foreign exchange and some of the other contracts that bull markets offer is that many of these are accessible 24/7 or near to it. So you've got quite a wide scope for the trading day. Nonetheless, you need to be realistic about, you know, how much time you can spend on your trading. Pick a time that works for you. I mean, I've highlighted that, but that's very important. You've got to, you're going to need to concentrate. You're going to need to think about what you're doing. It's not a good idea to be trying to trade the markets when you're having to watch the clock, when you're pressed for time. It's going to be, you need to make calm, sensible decisions, not hurried ones, which just put another layer of pressure and potential for getting things wrong. Let's make technology and modern communications work for us. These days the tools we've got at our disposal allow us to leverage our time and resources and to make the most of the opportunities we have. So we can access the markets from a much wider variety of places than we could have done in the past. However, you do need to think about where and how you're going to access market information throughout the trading day, because even if you're not trading, the whole of the business day, you may put positions on in the morning, again in the evening. You may want to monitor those and see how you're doing during the course of the day. How are you going to manage that? Does that work for you? So what are you going to need? Well, one of the first things you're going to have to think about is reliable and confidential internet access, and I think that's quite important. Those two phrases there, reliability. You're going to want uptime. Nothing more frustrating than trying to do a trade and finding that your network keeps dropping out. You haven't got good enough connectivity. Confidential. Well, at the end of the day, this is trading money. It's your private finances. You're going to want to do that in a secure way. You don't necessarily want people staring over your shoulder, or or having access to. Certainly don't want people having access to your records and what you're doing. So that reliable, confidential internet access, and that will be via a computer, a tablet, or a smartphone. But you're also going to need an environment in which you can concentrate and be free from distractions, even if it's only for short periods at a time. So, if the kid's playing, running around and making a noise behind you or at your feet while you're trying to work out what you're going to be doing in dollar yen today, it's possibly not the best way to be placing a trade. So, even if you want, 10-15 minutes of downtime to make your decisions, you should ideally try and allocate that time and find that quiet space where you can make those decisions and think about what you're going to do. I also would recommend some method of recording your trades and making notes. And it's not just the details such as buy and sell and the instrument you traded, but the reasons why you made the trade, and perhaps just as importantly, when the trade's closed, what the outcome actually was. And as you go forward, this will form a trade diary that you can look back on and refer to in the future. Now, the reason I say that is because we're all prone to making, we're repeating our own mistakes, or unwittingly. And I think what we need to do is look back and see from time to time where we've done well, where we've made money, and equally where we lost money. And if we keep repeating the latter, then we need to think about where our strategy is going wrong. But equally, we need to focus on where we've made money. If we can find common themes, common things that we can repeat and follow, and hopefully try and improve our success rate. So a trade diary, I think, is a very useful thing to have. But the most important thing that we need to think about in our trading plan and our trading strategy is capital preservation. And the most likely reason for any of us wanting to trade is to make money and to have a better life for ourselves, and that can be possible. But to do that, you need to improve your chances of success, and you need to be in the market for the longest possible time. And you need to protect and preserve and protect your resources and capital. And that, after all, is very hard to acquire. I mean, money doesn't grow on trees. If we had an endless supply of cash available to us, then we wouldn't be here, we wouldn't be trying to learn how we can perhaps make more money through trading. So preserve and protect your resources and your capital, because once it's gone, it's not easily replaceable. Bear in mind that this is not going to be a get-rich-quick exercise. Some people may have, initial success, and unless you could be, of course, that you turn out to be, the next super trader, the next George Soros or John Paulson. But for the the majority of us, and the likely reality for most of us, is that it's not going to be a get-rich-quick scheme, but rather one where learning from both successes and mistakes and applying those lessons could help create a long-term winning strategy. And that's what it's really all about, you know, making gains, more gains than losses over the longer term, and applying that strategy. Sounds like Clive would like to come in again.
I did some heavy breathing to let you know I was around. Yeah, I think that is a particularly important bullet point. It's not a get-rich scheme. There's so much out there. There's so many sort of promises, you know, things that go on this course. Pay £3 grand, we'll teach you how to trade you at 20 minutes a day and that kind of thing. It really is just not that easy. There's so many different things that you need to conquer, learn, understand, and get with. And I mean, that's why I'm really pleased we've been able to do these webinars, and that we've managed to do, you know, to sort of bring two sides of it together, you know, because I think it's important that you understand the fundamentals, the technicals, and also the psychological, and you know, and the idea of trading, and there's so many different things. So you know, I do think that's extremely, yeah, it's a well-made point that this is not easy, and it's going to require hard work, perseverance, and probably you're going to learn a lot about yourself as well over the course, you know, if you persevere at it.
Okay, thanks, Clive. And then finally on this slide, monetary discipline, which again I've emboldened and underlined. Monetary discipline should be the cornerstone of your trading plan, not least because we're often in this seminar going to be talking about leveraged or margin products, which in the end have a finite life. You know, we're not talking about trading things that you're actually going to, you know, stick away in the bottom drawer. You're going to enjoy the monetary benefits of ownership, the economic benefits of ownership if you're trading equity CFDs or margin FX, but you're not going to have something that's a long-term, you know, investment that you can call upon in 50 years. So moving along to our next slide, the trading plan, and this is key. Most people probably make the mistake of not having a trading plan, but you should sit down at the outset and think about what your goals are through trading, what you hope to achieve through trading. So, you know, goals might be, you know, to buy that super yacht and live a life of luxury in the Caribbean. What can you realistically hope to achieve through trading over various time scales? When will you be able to trade? As we've said, you know, unless you're dedicating all of your time to this 24/7, you're going to have to think, you know, where does trading fit in around your perhaps work or family commitments? And when are you going to be able to pay attention to the markets? As Clive said, you know, the idea that you can just commit 20 minutes a day to this and expect to do well is probably a bit of a fantasy. So you're going to need to decide when can you trade and how much time and when can you pay attention to the markets. Then think about what markets are you interested in. You know, there's many to choose from, but what floats your boat? But I guess most of us are here because we've got an interest in FX today, but you may have other interests too. Allied to that, what markets do you understand? There's no point in trying to trade a market you don't understand. In fact, that's probably the last thing you should do. If you don't understand how something works, you know, ask a question. We're here to try and answer questions, but there's plenty of information around, and you know, the brokers you speak to will be happy to try and answer a question or point you in the right direction. Clive,
can I say something about that, Des?
Please do.
What are you interested in, I think, is definitely pertinent, but the second one, what markets do you understand? I think that well, my journey was that I look at charts because I thought I understood markets and fundamentals on markets, but it turned out I didn't, because the markets just go off and do whatever they want. So I think sometimes, and that's, you know, it's my sort of humble way of trying to say, I think that yes, markets, do you understand the markets? Do you really understand the markets? Do you? And I think it's very important not to allow preconceived beliefs to run your trading. I've seen so many people who say, I don't believe that equity markets should be going up because it's all being manipulated by central banks, and that's ridiculous, so I'm going to spend my entire life shorting equity markets to try and make money from that belief. Well, if you'd have done that for the last 2 or 3 years, you would have lost all your money because it doesn't matter what you believe. The markets have gone up because central banks have been pumping liquidity into them. So your beliefs may be true in the end, but you're going to lose your money. What was it? It's a Warren Buffett phrase, wasn't it? I think markets can remain irrational longer than you can remain solvent.
I've seen that quote attributed to a few people, but it's nonetheless, whoever said it, it's very true. Yeah, and it's it's sage words of advice, definitely there, Clive, without a shadow of a doubt.
Yeah, I mean, it's just from personal experience. I really did think I understood the markets that I was broking when I was broking things in the 90s, and then the markets would go off and do something completely different, and you'd say, well, what was that about? And people would say to me, well, look, the market wants to go up, or the market wants to go down. That was a bullish number, but the market wants to go down at the moment, and that's why I ended up looking at charts. And I think because I can understand the charts better because they just say to me, look, this is going up or this is going down. Don't worry about what you think or what you believe. The reality is X, Y, Z. And so that, for me, that was part of my journey, and where I ended up doing what I'm doing is because it made a lot more sense to me not to question why or to try and work out why, but just to say, well, look, that's what is. You know, that is what is happening. That's the reality. There's nothing I can do about it. Whatever I think isn't going to change it. The market is going up or is going down. So just get on with it. You know, and I think that's an important message. To repeat, I've just seen so many people lose money on opening up trading accounts to trade a belief that they have and blindly ignoring the reality of where the market's actually going.
Yeah, very Clive, all sage advice, and we'll touch on psychology of trading briefly at the end of my slides. But having an ego, and that's ultimately what that boils down to. I know I'm right, and trading on your ego is probably one of the worst things you can do. There's many of them. And if we could wave a magic wand as traders, we would remove all of the emotion from our trading decisions. You'll say, Clive, that's what charts allow you to do, and I think there's a lot to be said for that. What of course it doesn't do is remove the emotion from the person that pulls the trigger, makes the decision.
I think it can. I'm not completely certain you can remove emotion from trading, but I do believe that charts can allow you to mitigate some of it and to put it in a box, if you like, But as you said, I'm sure you've got some slides touching on that sort of thing later on. Trading isn't about satisfying your ego; it's about making money. And a lot of people do it so they can go to dinner. I think a lot of people open trading accounts and trade because they like to go to dinner parties and go, oh yeah, I knew gold was going up, so I just opened an account and I bought some gold. If they'd have done that in the last 2 years, then they wouldn't be making that boast at dinner parties because all gold's done is go down, So they've so their ego got lost the money, and at the end of the day, that's not what trading is.
Now, this is a fitting point to come on to the last point on this slide,
good
which
man.
is
I'll let you go.
How much risk capital can you commit to trading? And risk capital is the key here. Risk capital is money that you can afford to lose. So it's not the mortgage money, it's not the kids' school fees, it's not the food bills for the next month or so. It's money that if it disappeared tomorrow wouldn't materially affect your lifestyle. It wouldn't see you out on the street, you wouldn't see your kids go hungry. So how much risk capital can you afford to commit to trading? That's a very important thing to consider when making any kind of trading decision. So carrying on with our trading plan, you're going to need to consider how you're going to divide up your risk capital and think about your attitude to risk and your ability to suffer a loss. So for instance, if you've decided to commit £1,000, which is roughly $1,600 of risk capital, money as we said you can afford to lose, you might then decide to portion out that £1,000 into about 20 units of £50 each. You might decide to keep a third of that in reserve and have no more than 50% of the remainder committed into the market at any one time. And that might be thought of as a conservative approach to risk. Conversely, you might take the view that you want to keep just 10% of your capital in reserve and put the balance of 90% of your funds into the market at any opportunity, and that will be seen as a much more aggressive approach to risk. You know, there's no hard and fast rule to say which is right, but each person will have a different approach to that and a different you know, ability to suffer a loss. But the reality is, you know, if you're sensible, you're nearer to the first of those two things, two options there, then, you know, preserving your capital, having more units to trade with, keeping some back in reserve, you're more likely to be in the game over the longer term than you are if you go balls out and you know, blaze away in the markets. You'll burn very brightly, but probably burn very, very fast as well. So, you know, summing that up, really, we need to think about risk and reward. Well, risk has a, you know, as we just discovered, is the amount of money we're prepared to lose. Risk has a potential payoff, and that is reward. We need to think about the relationship between these two when we trade. We should seek to limit one, which is risk, and maximize the other, i.e. reward. This relationship is known as the risk-reward ratio, and in essence it's the potential payoff from taking a risk, or sorry, in essence we can say that the potential payoff from taking a risk should be more than sufficient to justify that risk. And as a rule of thumb, the payoff should ideally never be less than 2 to 1, although some people might trade on smaller risk-reward ratios. But from your perspective, you want to be getting back twice as much money as you're risking before you know, if we even consider putting on a trade. So the potential reward should be at least twice the size of the risk taken trying to earn it, and ratios of 3 to 1 or ideally 5 to 1 will be better still. This ratio is reflected in and applied through the disciplined use, or can be applied through the disciplined use of stop losses and take profit levels. And I think Clive would like to say something again.
Yeah, this is an essential part of trading for me, and an essential part of and how you can use technical analysis to trade. And I've actually got a couple of trade examples that I'm going to try and show at the end that show exactly this in play, if you like. One, whenever I'm doing these kind of things, I always try and sort of liken the whole risk-reward thing to going to the casino, if you like, okay? Because if you go to Las Vegas and you sit on the roulette tables and you play black or red, okay? So you're putting your chips on whether the market's going to, whether the ball is going to go into black or red. That is basically, apart from the green, obviously the one green number is a 50-50 bet. Yeah, you're going to either, it's pretty much either going to be red or black. That is a 1-to-1 risk-reward ratio. That is heads or tails kind of stuff. When you're trading, you want the odds to be stacked in your favour, and you want to be able to say, I'm going to make, I'm going to put this trade on, I'm going to make at least double the amount that I'm prepared to lose. And that's exactly what Darren's talked you through there, is the idea that you should never try and put on 50-50 trades. If you do want to put on 50-50 trades, then my suggestion would be go to the casino, enjoy yourself in Vegas, and they'll give you free beer while you're sitting next to the table. So it's great, you know, you get free beer. There's no point but that's not what the markets are. The markets are not gambling. Trading is not gambling. You should try and put on trades with the correct risk reward, and try and also always try to make more money than you're prepared to lose. And again, that comes down to psychology as well, because your brain is wired for you to take profits quickly and run losses for a long time. That is the way the human brain is wired. I don't know whether you've got this in later slides. I think you were talking about psychology, Dan, but that's how your brain's wired. You need to try and turn that around and avoid that situation, and actually, you know, have disciplined trading with stop losses, as your last bullet point there says, and make sure that your trades are actually structured properly so that you can give yourself a chance to make money trading.
Okay, thanks Clive, that's lovely. All right, let's move on then and take our next slide. So what we're trying to do in this slide is just talk about what we actually mean by a stop loss and a take profit, and again, we're going to come on, we'll cover this in more detail going forward, but a stop loss is the point at which we have decided to limit our losses on a given trade, and this reflects a trader's appetite for risk and ability to bear a monetary loss. Ideally, a stop loss should be defined at the beginning of each trade alongside the take profit target. So when you enter a trade, you need to know precisely how much money you're prepared to risk, i.e. lose, and what your expectations of profit are before you pull the trigger. In some cases, you may physically place the stop loss alongside the opening trade, and perhaps even to take profit as well. Or alternatively, it may just be a mental note and an alert level, but you should definitely know what these points are before you enter into a trade. And in terms of where you set the stop loss, again, we could talk a lot about this, but you should certainly give consideration to factors like the average range of the market, the tick size, and the amount of capital that you want to be at risk in any given trade. I think this is very important, this last point. Stop losses need not be static, but they don't have to be a line in the sand that you don't ever cross. But ideally, they should only really be moved up behind a winning trade rather than moved down in the face of a losing one. And that green line in our chart on the right hand side, moving from our stop loss, which is here in red, in our area of risk, and going out towards our take profit, our area of reward, is meant to intimate that of course you can move this stop loss up to the point here at trade entry where you'll be flat. And above that, if you're working a stop above the area that you entered the trade, then you're potentially locking in profits. Now that might not always be the case because of a thing called slippage. Again, we'll come on and talk about that in future seminars. But the idea that you should really only ever move a stop loss up behind a winning trade rather than down in the face of a losing trade is pretty key to consistently making a profit. There'll always be exceptions to that rule, but if you start thinking along those lines from the word go, you will be definitely thinking about things in the right way. So where do people go wrong?
You say, sorry, Darren, you say there's always exceptions to that rule. I know some extremely successful traders who would argue that there is never an exception to that rule, and that you should never ever move a stop the wrong way, so you're losing more money. If you have set a stop, it's because that was in your plan, and you should leave your stop exactly where it is, and the only way you should move it is to is in the right direction, i.e. to entry, as you just pointed out, or moving your stop into a profit. I mean, the best type of stop loss is a stop profit, and ideally your stop should be moved into a profit situation, and you should continue to try and let a trade run and make money for you, especially if you can get to a situation where that trade isn't going to lose money for you. And as I say, some of the best traders I know, they have a huge emphasis on stop management and making sure that stops, and one of their golden rules is never move a stop the wrong way.
Fair enough. Well, again, sage words from Clive there. So look, let's move on, because otherwise we're going to run out of time for Clive. Where do people go wrong? Okay, well the key, this again is not an extensive list, but these are some of the principal reasons why people go wrong and don't make money, and more to the point, lose the money they do invest and trade. They don't do their homework. They don't they don't attend courses like the one we're giving here. They don't read up on a market. They don't look at the historical context of the price of the instrument. Just blindly jumping into an FX pair or a stock without having any reference points about where it's gone, where it's going, where it's been, what's likely to happen to it in the near future. That would be a completely stupid thing to do. As would not understanding the drivers of price change for the instrument. If you buy or sell something and you don't really understand what's going to make the price change, when you're in that position, then why are you in that trade in the first place? They haven't considered their expectations from a trade. Just reinforcing. What's your risk-reward ratio? What are your time horizons for that particular trade? And coming back to the previous point, why are you in that trade to begin with? And if things are going against you, it doesn't hurt. And in fact, it's very good advice to go back and look at that. That's probably more relevant from an investment point of view than a trading point of view, but even in a shorter term trading environment, it doesn't hurt to question the reason you're in a trade and question your own thinking, and are you still sticking to your plan that you had at the beginning of the trade? Because if you start to have, if you like, style drift and you're doing something completely different than you were when you entered the trade, then maybe it's time to close that trade and think again. They enter a trade at the wrong point in its life cycle. Sometimes that will be too early before a trend's clearly defined, or what you expect to happen hasn't happened, and you preempt it, and that piece of news or that decision, that rate decision perhaps goes against you, and you're too early. But more often than not, people enter a trade too late. They're acting on old information. They're jumping in when the clever money and the majority of other traders are jumping out. They haven't nominated or respected their stop loss or maximum drawdown level. Clive has already alluded to this. He's just made the very good point that our brains are wired to run losses and cut profits. So they snatch at a small profit. So running losses and cutting winners are the two principal reasons why people lose money in trading. One of the hardest things to overcome, but clearly what you should be doing is cutting your losses, hence the need for the disciplined use of a stop loss, and running your winners. Stay in a winning trade, as Clive says, with a stop profit behind it, and run that winning trade for as long as you possibly can, because by doing that you will increase the amount of profit you make on a winning trade, and by cutting your losses early you will reduce, or with this with a disciplined stop loss, you will reduce the amount of money you lose. And that obviously comes back to our idea of preservation of capital and the idea of growing our capital with winning trades. So just a quick look really at the psychology of trading. Again, we're going to have to come back to this in much more depth in another webinar, but psychology of trading is part of a branch of science and academia called behavioural sciences, and this studies areas such as decision making, emotional responses and crowd behaviour, all of which are integral to our profitability in the market. This is a key point here. Crowds behave in the same way as cyberspace as they do in the physical world. It's quite an odd scenario, but just as animals act on the savannah in Africa as people used to act on a market floor when we had those, they act in the same way in screen and phone trading. The herd instinct takes over, and in extremis this can drive a bubble, and in a bubble we lose our sense of judgment, and feedback loops reinforce this behaviour. And what I mean by that is we listen to and justify our own story rather than looking and thinking outside of the box. So people in a bubble, they've got a particular investment view. They only read and talk to other people who have the same view as them. They're constantly justifying their position, and they're constantly reinforcing their own views. Well, they're not looking at the wider world, and they don't realise what's going on until it's too late and the bubble bursts. So again, this is the extreme of market psychology and crowd behaviour, but we'll just have a brief look at what happens. Here's a trend developing. It doesn't really matter what it is, but the trend starts to develop. Early adopters come in on the trade. The trend develops further, and more and more people jump in on the trade, and we move along to a point where we approach what I would call the historical valuation boundary. It could be the PE ratio of a share. It could be a disparity between two currencies, but there's some kind of historical average which says, at this point, historically, we've seen some sort of mean reversion. There's been a correction, and things have fallen back into line. But in our bubble scenario, none of these people pay any attention to that historical valuation boundary. Through they go. This time it's different. To some of the most frightening words you'll ever hear in investment markets. Brilliant example of that would have been the internet bubble, and people were convinced that companies that didn't have a business plan, didn't have any profitability or any obvious way of making money, were the new paradigm. It was all very different this time. Well, it wasn't, and when bubbles burst, they don't deflate very gently, do they? They go, bubbles and balloons. When they go off with a bang, and everybody loses at the same time. That's what happens. Everybody tries to head for the exit at once, but the doors have been firmly closed in their faces. The bubble's gone, and so has your money. Now, Clive has mentioned a very, very important book on market psychology before, but here just to reinforce that, The Extraordinary Popular Delusions and Madness of the Crowds by Charles Mackay, published first of all in 1841. What's extraordinary is that book was published, the best part of 150 years ago. He was talking in that book as well about events that were perhaps 150 years before the actual date of publishing. what is true then and was true in the bubbles that he talks about up until 1841 is true today of investor psychology. The link on the bottom there is a link to the book on Project Gutenberg, so you can have a look at that for free and read that book if you get the chance. I'm going to jump off now and pass you over to Clive, who will run through some live examples, I believe, with his lovely charts.
With my lovely charts, yeah. Yeah, it's different this time. What wonderful words they are. And yeah, I think I've heard that particular phrase used a lot in recent months and years with respect to the London property market. In fact, dare I say it, and you know, there are signs of that being on the wane now. Right, I'd like to put my screen up now if we can. Is there somebody that can help me achieve said end? What do I press? Change. It's not webcam, is it? Misha, can you allow that to happen, please? Let me have the screen, and then we'll go through a few charts and call it a day. When ready, show my screen. That's the button we want. Right, and let's see which screen we want. It's usually that one there. Bang. Okay, should be looking at a chart now for Euro Yen, and I think Darren mentioned, you know, it's just amazing how me and Darren tend to sort of look at, have the similar thoughts. I think he had a chart for dollar yen up, which showed this massive spike that we saw last week when the Japanese announced that they would be willing to, or that they were planning to, you know, pump more money in, add to their QE program, if you like, and you know, I think that's given me a trade opportunity this morning, something that I'm looking at, and so, you know, this is what I've got. I looked at that this morning and thought, well, it would be worth buying Euro Yen at 141.80. And with a stop at 141.20, we've got 3 targets there. I'm going to come back to the slides in a minute because the slides are very relevant to everything that we've just looked at. Basically, I've been triggered on that trade because we've been down. The low today, this is a daily chart, and the low today has been 141.70. So I'm long of Euro Yen. The reason why I like this trade is because we have a support level here at 141.50. Which is something us candle heads call a Marabuzo line, and we also have another support level which used to be a resistance. Okay, so that was the high in September, 141.25. That could now easily become, it could flip and become a support level. We've also broken this gentle downtrend line here, and that's what's prompted me to think that we have a trade, we have a long trade to consider in this one. So look, that's what I've said. I said I'll buy the Euro Yen at 141.80, and this is what I put together for this trade. Buy at 141.80, have a stop at 141.20. Now my targets, I've got 3 targets in this trade, 142.50, 143.50, 145.50. And again, if we look at a weekly time frame chart, there are those targets. There's the first one, that high is the second one, and that high is the third one. That's where I've got those targets from. I'm expecting this market to keep going and to eventually reach this high, which was the December 2013 high. So that's how we've structured the trade. That's another trade. Okay, and we're saying basically, so if we look at this, I'm sorry, I've got another thing here. Once the first target is hit, move the stop to entry to protect capital. So what we're saying there is we're talking about moving the stop as soon as we can to make sure we don't actually lose any money on the trade, which is a kind of part, you know, it is ingrained with those principles that Darren talked about on his webinar, and I was butting in all the time and causing him bother. But yeah, the idea is that you are protecting your capital and making sure you're not losing your money. You've got to try and hold on to your money. So looking at that trade as it is right now, we are risking, oh dear, sorry, we are risking 60 ticks, okay, or 60 pips. The reward will be 140 ticks or pips if we hit all 3 targets. Okay, what that is you know, I've added up these 3, divided by 3 to come up with the average price, and then take that off of there, and that says to you that if we hit all 3 targets, we'll make 140 ticks. I always talk, sorry, I'm from the futures markets background, so I always talk about ticks. I know that FX is often talked about in terms of pips. Okay. So 60 tick loss or 140 tick win, that means that we have a risk reward ratio of over 2 to 1. We're going to make at least, we're looking to make at least double what we're prepared to lose. If you wanted to improve that reward to risk, and you really were confident that we were going to get to those ultimate targets, then you could say, I'm not going to cover anything at the first target, I'm going to cover at target 2 and target 3, and therefore the whole trade's going to make me 270 ticks, which is a very good risk reward against the 60 tick initial risk, if you like. What are the reasons for that trade? It's in line with the strong current trend. We've obviously got this clear move higher that's happening in that particular currency. What is it, a pair or a cross, Darren? Sorry, again, I'm showing my ignorance here. You were doing this the other day, weren't you? In that particular currency pair.
Well, yeah, I mean, it is. Some people would see it as a pair because they'd see the euro as the equivalent of the dollar. Now in modern FX parlance, it's okay to talk about pairs. For a purist, you know, sticking to what he was taught as a lad, I would say that that's still a cross. But we can have a debate about that another time.
We shall call it a cross, right? So, to me, looking at that chart, the upside looks pretty clear. And this is about risk reward again. What we're saying is that by the look of that chart, it should be easier for it to travel higher than travel lower from where we are right now, and the reason for that is that there's fresh air above, if you like, whereas there's several support levels between the entry and the stop. Now, I haven't shown them all on the chart I showed you, but what I'm basically saying is, let's go to the daily so we can, where's my daily chart gone? Okay, is we're saying that we're buying it here and we're selling it, we'll get out if it goes down to somewhere around here. But we're looking for it to go up to eventually here. Okay, so what my chart is saying to me is that we should be able to travel from here to here pretty easily, whereas traveling from here to here should be more difficult. Now, I'm not predicting the future. The technical analysis isn't there to predict the future, unlike what some people think. I'm predicting probabilities, and what the chart is suggesting to me is that we have a reasonably clear path higher, whereas we have a cluttered path lower. Therefore, the market should take the easier path and go up. So we will have a winning trade. And that's why that's why I'm suggesting buying euro yen this morning, to give you an idea of how a trade can be structured. Another thing I wrote on my reports today was that the FTSE futures had a resistance level at 64.80, and if you were to sell it below there, which is pretty much where we are now, we've been there once already today, and we're just having a rally back to there again now. If you put a stop above 6,500, and then we've got our target 63.72, 62.30. So we're risking again 50 ticks on the trade. We're risking 30 ticks, 30 to 35 ticks on that trade, but our potential reward, even if we go to the first target, is 100 ticks. I.e., we're going to make we're looking to make 3 times more profit if we hit the target than we would do than what we will lose if we get stopped out. Now, Darren's talked about the psychology of trading and the human brain being wired, and I talked about it as well, to see you making bad trading decisions. Hopefully, this is a snippet of how you can plan your trades, plan your risk reward, make sure that when you're putting on a trade, it is right with respect to all of those things, and then you can just walk away and you can say, I've done all the planning I can do. I believe that this is a good trade to do, and so I don't have to beat myself up about it if it's going wrong, or I don't have to worry about whether to take the profit if it's going right. I've set the parameters. I can leave the trade. That's what the most successful traders in the world do, and that's why they are successful, because they are removing a lot of that emotional aspect from the process. And again, it's interesting, Darren talked about having reasons for your trades, and I also try and include in there concerns over a trade sometimes if I'm doing my doing a trade plan. And obviously, and the other thing Darren said, which it's amazing, great minds and all that does, is what's the outcome. I always try and have the outcome as a final thing, which you can write in at the end how it got on, and try and learn from anything that went on, whether that was good or bad, and what you should have done, what you missed, what you could have done better, and try and continually keep learning about yourself, about the markets, and about price action. Finally, just one thing on this reward. This is my last slide, and I've sort of thrown this one in at the end. If you have 7 losing trades of 30 ticks, you'll lose 210 ticks, yeah? If you have 3 winning trades of 100 ticks, then you'll make 300 ticks. So that's saying that you can have 7 losing trades. You can lose 7 out of 10 times and still make money. And I think that's something that's worth having a think about. And that is exactly what I'm talking about. What we're talking about when we're saying keep your losses tight, keep your profits, try and run your profits. Okay, so if your winning trades can make you 3 times your losing trades, then you can have more losing trades than winning trades and still win. I hope that all makes sense. And I think it's something that, it's probably a good place to sign off. Thank you for listening. I'll pass you back to Mihail to sign off with you guys. Thanks very much.
Thanks, everyone.
Thank you guys for your attention. We'll see you next Thursday at 11 o'clock UK time. If you have any questions at all, you can always send them to mo@admiralmarkets.com. Otherwise, I will see you all next Thursday. Have a nice week. Bye-bye.